Hey, real estate agents, welcome to the Weekly Closer. I'm your host, Jeff Underwood, along with my co-host, Joey Sampaga. How's it going today, Joey?
Pretty good, pretty good. We are doing this thing on in the cloud, I guess.
I think we qualify for social distancing now.
Yes. Not far enough, but we're good.
And you even took it further. You've got a mask on.
I do.
All right, guys. Hey, we've got an amazing guest with us today that's going to really shed some light on what's going on out there especially in the mortgage world right now, because I think a lot of us as real estate agents don't realize the impact of some of the things that are happening around us right now and what that's doing in the actual mortgage industry. So we've got Jason Frazier with us today. Hey, Jason, thanks for joining us, man.
Jason.
Hey guys, thanks for having me, man. I appreciate it.
So Jason's joining us from CF Wholesale. Also, he has his brand Mortgage X podcast and mastermind.
Yep.
How's that going for you, man?
It's going good, man. I started that back in November, and it's great. We're growing. We don't have like too many people in there. It's a little bit over 650, I think, but it's a very engaged group. Done a ton of content. Great guest interviews, and really just it's really focused around people that when we started it was like, hey, 2020 is going to be a great year, and you need to step your foot on the gas and go. But we still believe, obviously, you still need to grow, and right now actually I think is a great opportunity to do a lot of that. But obviously we're dealing with stuff that we had no idea what we were going to be dealing with towards the end of 2019. But it's been just a really good group of people coming, just like, hey, I have no idea what to do right now. Like let's bring in some people to help guide them through these times.
All right. So you've been connected with mortgage and real estate for how many years now?
Now what are we? 2020. So 11 years.
All right. All right.
Yep.
So agents and loan officers that might be watching or listening today, how do they follow the Mortgage X brand that you have?
Yeah, so I got a few podcasts. I got the Marketing Interrupt podcast, and then which is really just focused on marketing, obviously, and then the Mortgage X, which we focus on what we call the X factors in the mortgage industry. But what we try to do is find people that maybe haven't been on podcasts before. People don't know their names or whatever. We try to go find the people that are just putting in the work. They're doing some amazing things that just don't get the press that other people do. So just finding those X factors, and my co-host of that is Christine Beckwith, and who is a great mortgage veteran and a very skilled mortgage veteran, and she runs her own coaching group called 2020 Vision for Success. So Mortgage X Mastermind, that's the best way. I mean, you could find me all over any social media. LinkedIn and Facebook are my two main channels, but Mortgage X everywhere. But Mortgage X Mastermind and Facebook is the best place.
Awesome, man. I appreciate you being here.
Yeah.
So let's dive right in. So what the heck is happening, bro? This mortgage industry. I mean, I'm hearing a lot of things out there, and you've seen the headlines too. So
yeah, it's
how do you want to break that down for us?
Yeah, so I'll try to keep it all concise, because literally this stuff is changing by the second, and I'll try to keep the information towards what I think it's for everybody, but like I'll try to focus more on like what agents, because honestly there's a lot of loan officers out there that don't really understand the back end of what's happening on the secondary marketing side, on the capital market side, and then agents to go along with that. I mean, rightfully so. This isn't their job. That's not what they do. They focus on the buy-sell side. Some of them are, maybe old loan officers or whatever, and they have a little bit of insight into it. But I'm finding, I was interviewed in another mastermind group, and there's just a lot of agents that had no idea what was happening on the back end from the lending side. So I'll just kind of start. One is agents right now, be very patient with your loan officers, because there's a lot of things that they're dealing with that is 100% out of their control right now. Good. I know that it's going to be frustrating. I know it's going to be stressful, complicated. That's our industry anyway. But now, especially, loan officers have so many things that are just 100% out of their control. You're just going to have to be patient with a lot of things. And it's whether it doesn't matter if they're a retail mortgage loan officer or a mortgage broker. I work for a wholesale lender, so my clientele customers are mortgage brokers. But I'll just give you some examples, and right now just agents, because it's one thing that you all need to prepare for. So I know some agents that would niche with a particular set of mortgage loan officer with a certain niche of product, which is widely known as non-QM. That has completely evaporated, basically disappeared within a week. It's something that's been around since 2014, since they introduced the qualified mortgage rule TRID, and then non-QM, which is the non-qualified mortgage. So there was a lot of loan officers that went all in on niching on that product. That's completely gone now. Some of the top lenders that were servicing that niche are basically out of business, or at least in suspense for the foreseeable future. So that's one thing.
How many people do you think that's impacted? I mean, as far as in the mortgage business, how many companies do you think that was kind of
well, one is it impacted so there's a lot of lenders out there, right? But anyone that had any type of non-QM product, which was most lenders, that it affected them. Now there's certain lenders like an Angel Oak and just a couple of, I don't really pay attention too much to the non-QM side, but Angel Oak being probably, I would say, the gold standard of non-QM. They were billions of dollars in origination. They had to tap out after like a week in the market just because there was no liquidity for and no appetite to buy on the secondary market of the loans and the deals that they had, because they're more riskier pool, right? So when you think about non-QM, what is that? That's people that don't fit into that nice QM basket that the government came up with. Dodd-Frank, we have to thank for that. But think about people that are self-employed. So think about those that just don't fit in the traditional guidelines. Non-QM was a good product for them. Now you had brokers that would broker straight to a non-QM lender. You had retail channels that had an investor that did non-QM product, like a Redwood Trust was another big name that tapped out of it. So Sprout Mortgage, another one, and Fund Loans. There was just a lot of different ones that just, and it was funny because, well, I mean, it's funny, but it's ironic one day to be like, oh, we're still accepting them. We're good. This isn't hitting us. We're positioned well. And then the next day they're like, oh, we're not accepting any new locks or new applications. I mean, that's how quick this stuff happened. But literally that whole market, and we're talking billions of dollars. That whole market evaporated within a week. And so that, just to give you an idea of the volatility that's happening on the mortgage side.
That reminds me, just so you know, you probably remember New Century.
Yeah. Yep.
Yeah. That reminds me of, because I was in the mortgage business back when the last one happened.
Yeah.
I remember New Century, 1 week the reps coming through, and the next week they're like, we're done.
Nope. Next week they're done. And we were talking before we went live here about the implodometer, and it's kind of, we technically have a little bit of that now. We had a couple big name lenders like Mr. Cooper and Impact Mortgage yesterday tapped out for suspending operations or originations for 2 weeks or till the end of April or whatever, really just kicking the can down the road. We hope they pull through. I never wish any lender to go out of business, because there's people and families involved, but that's just absolutely. I'm just looking at the reality of the situations, and now how this affect agents is so when I was posting the non-QM stuff, I don't know if you saw that a couple of weeks ago, and there were agents, friends of mine that were like, yeah, I just lost my 1.2 million jumbo that was in a non-QM package. There was one that I just lost this $1 million because a lot of high balance, high ticket loans were in the non-QM bucket for whatever reason. And so a lot of those agents lost those deals, right, and had to go find a new home for them. Now, unfortunately, depending on the structure of that clientele and where they were doing their business, there wasn't anywhere else to put those loans, right? And people were trying to, like, I'm putting that loan here, I'm doing that loan here, doing that loan here. One thing, so that's non-QM, right? So that, I think we've covered the non-QM. That's if you were and look, and if you're a loan officer thinking like, okay, they're going to come back, sure, maybe at some point, but let's look at, like, now is the time to pivot, because that's done right now, and it's going to be done for the foreseeable future. And so I wouldn't try to find places for this stuff. I would definitely pivot, which takes me kind of to the second category, and that's government lending. And we all know, which is pretty substantial part of the market and pretty substantial as part of everyone's business. So right now, as agents, my advice to you is to get with your loan officers and just have conversations. Now, granted, there's a lot of loan officers that don't want to have these difficult conversations, right? It's not out of the realm of possibility to see these loans take 60 to 90, even more days to close because of capacity issues. There's just a lot of volatility going. But if you're an agent, you could have that at one time a month ago was a very qualified client to get into a house that maybe, let's say they've been approved, everything's good to go, loans locked, everything's grand, their credit was maybe at like a 660. And then come to find out here, we're getting ready to close, getting that clear to close, and that borrower is no longer qualified. I've seen a lot of that happen over the last few days, where qualified borrowers are now out of the market because of their credit, because a lot of lenders, both retail and on the wholesale side, are putting minimum credit scores out there. So right now, what I'm seeing on average is around 640 to 660 being the minimum. So if their credit score is underneath that, they're not getting a loan until they get their credit score up. And DTI, right, the debt to income ratio, below 50%. I've seen some lenders make their minimum credit score 700, right? And there's a lot of people, a lot of loan officers, a lot of agents who had a niche of helping borrowers with like down payment assistance programs, bond programs. That was their niche. You're going to have a very hard time doing that type of business right now. Us at CF Wholesale, our minimum is 620. We're probably I can only think of maybe one or two other companies that are that low on the credit score. But that could change. Like we could be up at 660 by the end of business today, right? Like it's that fluid. And what everyone doesn't really understand is the reason for that is that government lending has tightened up to where, just to give you guys just a real simple example of how it works is, and I'm not going to get into the whole, I'm not a secondary market guy. I'm not a capital markets guy. I listen to those people. I know some very smart people in that territory, and I listen to them. I listen to people like Barry Habib, who is, in my opinion, the foremost expert on the mortgage market right now. So listen to Barry Habib. If you come to the Mortgage X Mastermind or follow my content, I have videos with Barry. I have interviews with Barry. He goes into depth on what this means. But just let me give you an example. Is when a lender does a loan, right? A lender doesn't necessarily keep that loan in their portfolio and basically, take on that risk. They sell it in the secondary market to an investor, right? Right now, there literally are getting no bids. There's zero appetite, or getting a very, very cheap bid, maybe 10% of normal value of these loans on the secondary market. I'd actually welcome that. We're not seeing any bids on the secondary market, meaning these investors aren't buying the loans, right? And so that's why they're tightening up the risk by changing the DTI, changing the credit scores, so that the risk isn't as much, and they can have a better pool of loans to sell to investors, and hopefully investors coming back to the market. Now, a big misconception that's happened out there is that we had the Fed come, the government, they're here to help, of course, right? So they've actually caused a lot of these issues with what they've been doing. We'll get into the forbearance, issue and nonsense that has been going around from the media and the government. But let's look at getting back to the government lending. Is everyone's sharing these articles about, the Fed's going to make sure that the servicers stay whole, and this is where the forbearance will come in, but we'll get into that. Let's get into the chicken first before the egg. But so you have the Fed coming in, or the government coming in and saying, we're going to make these servicers whole. We're going to help them with making these payments, because what people don't understand is, like, if someone doesn't make their payment, right? Mm-hmm. If I don't make my $1,000 mortgage payment, that lender, at servicer, has to make that payment to the investor regardless of whether I'm paying or not, right? So when we have so many people out of work and whatnot, that ends up becoming an issue, especially when we get into the forbearance and the loan and not loan forgiveness, but loan forbearance. And people need to understand what the difference is of that, right? So all of that just creates a very volatile market for investors to want to buy loans. Now, people are thinking, okay, well, the government's making sure the servicers aren't going to go out of business and there's not going to be a mortgage crash by making them whole. That doesn't matter if investors aren't buying loans on the back end. And if they're not buying loans, then government lending could essentially be non-existent. And by what I mean by non-existent isn't like, hey, they're shutting down government lending, is that the qualifications are going to be so tight, the pool of people that actually could qualify. And by government lending, I'm talking FHA, VA. A lot of those just won't, there just won't be an appetite on the secondary market to buy these loans, right? And so that's the real problem. It's great that the government's doing that for the servicers, because that's one problem. The bigger problem is, how do we continue lending during these times? And you need the investors to actually wanting to buy these loans, right? And we just don't have that. So that's why you're seeing that when you're going, I see posts today like, hey, who's doing 580 FICO and all the, nobody. Like, nobody's doing that, right? That stuff. To a certain extent, some lenders may be doing a little bit, but this is the thing, and this is what I want everyone to be very careful. Agents, look, you're going to have and I'm going to tell you this, I'm just going to be honest with you guys. There's loan officers, one, that don't understand the back end market of this right now, right? Not every loan officer is created equal, just as you guys know. Not every agent is created equal. Some are more in tune with what's happening. One are more putting it in as their profession to really understand the market and how it affects them. But also understand that the loan officers are taking the information from that the companies are giving them, right? And unfortunately, just like we found out in the meltdown, companies are and it's not that they're lying, it's just the companies are trying to put a positive spin on it because it's changing by the hour. So if they came and said, like, this is what's going to happen and da-da-da, and then people start getting pissed, or loan officers like, well, I need to go to a lender that isn't, and the next day it changes and it isn't that bad, that's really what they're hedging against right now, right? So right now, a loan officer isn't, hopefully, a loan officer isn't lying to you when you're asking them the information. They just may not be informed. But I'm going to tell you that right now, there's a lot of misinformation going around, and I see it in Facebook groups when, some agents like, hey, my lender's only accepting this. I'm doing a Cal HAFA or some other, DPA or bond program. Who's accepting that? And then you get all these loan officers, chest beating like, well, I'm still doing it. Our company's fine, and blah, blah, blah. And I could, and what I posted, I'm not saying, well, that's bullshit. What I'm saying is that, like, be careful, because I could show you about 200 posts of chest beating and we're still doing X, Y, and Z from last week. And 100% of those are no longer doing what they were just chest beating about, because they were still okay and they were still taking loans, right? So you just need to be careful, as this stuff is very fluid. So when you're getting with the loan officer and you're looking to put these places, if you are, look, there is nothing right now in our current market, there is nothing attractive about DPAs, people that aren't putting a lot of money down, credit challenge. There's nothing attractive on the secondary market. And if there's nothing attractive about these loans on the secondary market, that means lenders aren't going to do them. And so if you've made your entire business off of that type of business, that type of channel, it's going to be very, very difficult for you. And just know, like, that loan officer could be 100% telling you the truth and saying, yeah, we're still doing DPAs and bond programs. And then 2 weeks now, that company suspends it because they know nobody's going to buy it, and they're not going to take on that loan and put it on their books. That's just not going to happen. So that's the one thing that everyone needs to understand, is that we're in a very tight lending box on government lending. Conventional is the best way to go. And we could get into some strategies on how to counteract that. But my final thing that I'll talk about is, as we go as I'm taking you kind of through the journey of what's happening in the market, is the forbearance. Right? I'll honestly have to say, I'm not a fan of Newsom in California, but that guy is a freaking moron with what he posted out there about, people that, these lenders are just gonna, they're not gonna make them pay for 3 months, right? Without getting to any real details about that. And everyone needs to understand is that consumers, by and large, are headline readers. And then you go and look in these consumer Facebook groups, and they're like, every lender in the country is letting people not pay for 3 months, which is absolutely not the case.
I think New Jersey just said that too, didn't they?
Yeah, and they don't know. I mean, just like the government when they did this whole and let's stop calling it a stimulus package. This was rescue. Right? This was a rescue package. It's great to call it a stimulus because that's what we all understand, but this was a rescue package. This wasn't a stimulus package for the economy. This was like, hey, we're about to implode. We need to rescue the economy, give some people some money.
Dude. I mean,
this is big.
This came out with when the last one happened. They've surpassed that.
No, this is nothing. I mean, now the benefit of this is that, unlike 2008 with here, is like, look, like the industry didn't just collapse. It was like, look, we had to put everything on pause so people don't get sick and die. Right. And so we are going to get past that. Those jobs don't go away. Everything will get back to some, level of normalcy, but it's going to take some time. And so this was kind of like that stopgap to get us through these times. And so when, and the reason I'm talking about this is because I've already seen agents post some freaking nonsense out there about, hey, I have clients that get in a house for less than, $1,000. Let's call me about making that stimulus check, for them. That is, one is you are doing a great disservice to the industry because you're making us all look stupid by doing that stuff. Second, you are doing a disservice to the consumer because that stimulus money needs to be for feeding their family or paying their bills or doing other stuff. Do not sit there and help people figure out how to buy a house right now, right? Be there as an advisor. Now, some people, economics, their job or whatever, it may make perfect sense to buy a house now, but you need to be an advisor. You need to be a counselor right now. Right now, I'm seeing a lot of tone deaf marketing out there and messaging that's about what can they do for me so I can make money, as opposed to let me be there as someone, as a counselor, as an advisor to make sure that they are in the best position to buy a house. So every time I see one of those, and they may be nice people, right? So I don't take my disdain for their messaging or marketing as an attack on their character or who they are as human beings. And I get that, right? Like we all want to market. We have families to feed. We're in that part. We need to do business, right? And agents in some states have been hit harder than others because of the shelter-in-place orders and what's been deemed essential or non-essential right now. But I'll tell you right now is that, look, it was hard, and we still have a shitty perception from 2008 agents and mortgage companies and banks and stuff like that. That hasn't gone away. It's been a little bit better, but it's still a bad perception. The worst thing we can do right now on something that's totally different than 2008 is double down on that crappy perception by doing that type of marketing, right? And so you need to be an advisor, you need to be a counselor. Stop putting those messages out about, and stop calling it a stimulus check because it's a rescue package. Once you understand that money was to rescue people, not to stimulate the economy, you'll understand the difference on how important that means. Like, we are dealing through sometimes. I just watched this video and it broke my heart yesterday of this dad trying to, because of his company not, giving money to, our delayed payments to his paycheck, something to go, his wife, same thing. So for a week he had $37 to basically feed his family for a week, and he did it. And he was talking about how he didn't break down, and you could tell he was breaking down, telling the story. But he's like, but we're getting money tonight. It's gonna be in the bank account, and I'm okay. It was a video. If it wasn't so personal, I would have shared it to everyone because I want people to understand. People are going to remember what you did during this time. People are going to remember how you acted, and if you tried to sell, if you tried not to really care about their circumstances and just only worried about your own, right? And people are going to, but I want people to understand that story from that dad with tears in his eyes, talking about, I didn't break in front of my kids. I didn't get frustrated. I didn't yell at him. I didn't let him see me get down, knowing that how am I going to feed my two kids, my family, for $37 for an entire week. But that's what people are dealing with right now. So could you imagine someone that is dealing with that and then sees your freaking Facebook post about, hey, let's make that money work for you by obviously buying a house. Look, you're already under attack for commission and not being worth that commission with the lawsuits and stuff like that. So like, really, and I'm telling you right now, this is where the cream's going to rise to the top. And I have no problem. I have zero problem seeing anyone that's going to do that type of messaging and marketing get pushed right out of the business from other people that are. Right? Look, this is the time where cream rises to the top. This is the time for opportunities, time to be advisor. And the thing is, if you do the right thing now and advise them and say, look, I have a lending partner. Let's see, maybe a refi makes sense to you. Are you selling your house? Maybe that makes sense right now. Maybe it doesn't. Let's talk to it. Create that prospect pool of being a professional, being an expert at what you do. And if it makes sense, then fantastic. But if it doesn't, then put them in your prospect pool. This is why CRM is important. Make sure you're tagging them correctly. Your messaging is correctly. No one gives a shit about spring right now. So all that automated spring email crap that you guys are sending out, nobody cares about any of that right now. Like, let's be human beings. And I'm doing this not because I'm like angry or anything. I'm doing this because like our industry has some issues right now, and we can't decide how we're going to come out of this. And I'm passionate about this. I'm also passionate about The agents that are afraid to go and post what I'm talking about online because they don't want to be ostracized by other agents or be, because how social media goes and Facebook like that. And they come to me and they say, I get every single day multiple messages from agents that are sending me screenshots of bad marketing from agents, and they want me to say something about it every single day, guys. I'm not kidding about this stuff. And sometimes I do. I try to do it my little snarky marketer type stuff and have a little fun with it. But I'm doing this because I'm passionate about this industry. I want this industry to survive and have a legacy for the professionals that have really given their time for this industry. And right now we're in a bad place as a society and a culture with the disease and everything like that. But let's be thankful that we're in one of those essential businesses. We're still doing production, at least my company, we're still doing production. We're still locking loans. We're still doing applications, right? We're well capitalized, so we don't have some of the issues that some of the other companies do. But I'm not beating my chest about it. I'm saying look, but if you look at our marketing isn't anything like that. Our marketing is about being an advisor. How do I help? Being a leader in your community. This is where leaders and this is where opportunity is made. If you look at a lot of self-made millionaires, billionaires, companies, all those great ideas, a lot of them come out of a recession, which we're going to be in. A lot of them come out of strife and crisis and wartime. And this is our chance right now to innovate, to be leaders and look at things. And then, I know I kind of went off on the tangent, but the reason why I was talking about this for the forbearance is that, with the government and the media saying about and everyone has this idea that they don't have to pay, is understanding what that means. A forbearance is not forgiveness, right? It doesn't because I'm saying I don't have to pay my mortgage for 3 months. It's no, your mortgage is on pause for 3 months. And then month 4, if you had $1,000 a month mortgage payment, month 4, you're paying $4,000, right? You're not paying, now that's just generally what forbearance looks like. Mm-hmm. Some servicers, some lenders will do something different. Right? Some of them will be okay, now you're on a payment plan, but you got to be careful because that payment plan will then have effect on your credit. That payment plan will have an effect on your equity of your house, putting it on the end of the loan. People are oh, well, I don't have to worry about it. Yes, you do. This is the type of thing is understand that and also what I'm seeing, and of course this should be a no great shock to a lot of people. You're seeing people that actually can't afford to pay their mortgage, but they're trying to get that forbearance so they don't have to. And people understand is look, when 30, actually it's not even that amount, it's a quarter. If a quarter of people don't pay their mortgage, that's $50 billion the servicers have to come up with. 50 billion, if that's just a quarter, right? Now look at the jobless numbers of 3.6 million people, and and that could go up to I saw a stat today that could go up to 34%. A 34% jobless rate, or unemployment rate, that's huge. It's more than it ever was anywhere at any time. Even in the Great Depression, the Great Recession.
47 million people, I think.
Exactly. It's 47 million people, and then you got 20, and I think it was 27%. It was the highest ever, right? And we're doing that, and now the worst thing is we're doing this quick. We've lost trillions upon trillions of dollar in market over the last 3 weeks, right? The economy went from a bull market to a bear market within 3 weeks. This is what's happening, and it's coming down into our stuff too. So you need to educate clients about their forbearance options and talk to them, and don't say, oh, you don't I know people that are literally just not paying their mortgage. They haven't talked to anybody. Right? I see it from my family members. I'm no, you need to, and that's why I did this content, say, talk to a mortgage expert, get your options, because they're going to know more. They're in the know. They've seen what lenders are doing. Some of them are requiring hey, on month 4, you're paying everything, right? Or you're going to get dinged for credit. And then you're still going to have to come up with a payment. So that's the thing, is know your options. If you can financially pay your mortgage or financially pay your rent, do so, right? Do that. Because you're helping the people. Because guess what? I know we all want to say, well, the owners, they're the cream of the crop. They're the ones that are, making all the money. They're doing all the other stuff. But it isn't so. There's some people that their income, they own a duplex or whatever. And if everyone decides not to pay their rent, that hurts them. And that takes everyone out of the economy. And so you basically have people that can pay, that won't pay, because the government made it a point to make sure that they didn't really have to show that it was, really hurting some of them are a little bit more stringent than others, but they didn't really have to show anything. That's how you collapse an economy, when everyone stops paying, because it all goes uphill, right? So everyone thinks like, oh, well, it trickles down, it's top down. No, this is bottom up, right? If everyone stops paying, no one's going to restaurants, no one's and then people understand, people that are not paying were like, oh, well, my job just got cut. Probably because all the people that doesn't have any money because you didn't want to pay can't. And look, I know everyone's going through hard times now. I know, I'm not blind to that. But if you can financially pay, then you should, right? Otherwise, we're going to have way bigger issues over the next, you guys hopefully have seen how quick this has happened. But those are the things. It's just understanding is like, one, that's why I'm saying be patient with your loan officers. Like, turn times suck right now, right? Getting loans closed sucks right now. And I haven't even mentioned, like, getting appraisals, especially in the lockdown areas, notaries. Now, so a lot of people have, governors have signed executive orders to allow for e-notaries. Drive-by appraisals is a thing now. But think about home inspections or contingencies. The iBuyer market has imploded, and that's a whole different topic. I'm happy to get in that too, because I have some very strong wording for them too. But like, that's the thing. iBuyers have disappeared from the market, which is an opportunity for you agents, of course. But same thing is like, and a lot of iBuyers have screwed over consumers that were closed, that they're bought a house and now they're carrying 2 mortgages, right? Because the iBuyers decided to cancel those contracts.
I heard about some cancellations.
Yeah. So that's my big, rant diatribe on what the mortgage market is doing. Like I said, there's way smarter people on this than me that are in the capital markets, but I'm not talking to lenders. I'm not talking to loan officers. I'm talking to the capital secondary markets, the money people, about hedge costs and things of that nature, margin calls. That's who I'm talking to really understand. And a lot of that information I'm getting from Barry Habib. I'm getting it from Anthony Casa, who's the chairman of AIM. These are the people that I'm getting the information on. I'm talking to my own capital markets people. These guys are in it. Anthony's talking to the capital markets from everybody to get a better understanding so that we could prepare for this. A lot of the crap that everyone's like freaking out about this week, Anthony was talking about like a week and a half ago, right? Like trying to like sound the alarm saying, hey, then of course he gets, people are like, oh, he's an alarmist. Oh, everything's not going away. It's like, guys, you got to understand. And if I hear one more person reference 2008 as in like I made it through that time, so like this isn't nothing. It's like, This is way worse than 2008. Use that experience. Hopefully you're learning from it to adapt and change. But people need to stop going back on that. I went through 2008 too, but this is different. And I did it both on both sides. I did it through on the mortgage, coming on the tail end of the mortgage side in 2009, and I did it at a over $8 billion hedge fund, and saw billions of assets under management go away quickly, and personally losing over $500,000. So like, I'm telling you guys, like,
I've seen those posts in some of the Facebook groups. I've actually commented because I do see people say, well, I made it through the last one. This is going to be fine. It's not anything different. And then I have to post, well, look, nobody's been through what we're going through right now. It just hasn't in history.
No.
So I think even Robert Schiller, there was a good quote I got from him that I shared with that group that, he basically said the same thing, that he's never, ever seen anything like this.
Nobody has, right?
And have no idea how it's going to play out. So
yeah, I mean, there's blue sky at the end of this. Don't get me wrong. I'm not here to be a doomsday guy. I'm here to be a realist, right? Because that's the problem in our profession too much, is everyone wants to put their head in the sand and hope for, whether it's compliance, whether it's marketing, whether it's anything, is like no one wants to really talk about the realities of what's happening right now. Look, I'm not saying 2008 wasn't bad. I'm not saying that there wasn't lessons to be learned in there. What I'm saying is that what we're going through right now is completely different, and in fact worse than what 2008 is, because I'll tell you right now, in 2008 we weren't afraid to shake hands, all right? And I'll tell you, in 2008 we weren't afraid to we could go eat at a restaurant if we could afford it. We could go eat out dinner. You're not doing that now, right? And that's the thing, is like, look, we're talking about something that could change our country forever, how we deal with that's all I'm saying, is like, look, this is a bigger picture, so just think about that.
Oh yeah, I mean, you think of what industries were involved in 2008. I mean, you're talking about mostly the financial institutions and real estate and mortgage. That was the big piece.
Yep.
But now it's like everything.
Yeah.
like everything.
And in fact, and if anything, we're the most stable. Like, I mean, out of all the industries that I feel bad, and I'm just saying, like, it's just ironic. I'm laughing at the irony of it, is that we're honestly like the most stable of it, thankfully. Like, like a house that people have equity in their houses. Thankfully, people aren't underwater. I mean, that's the thing, is like, thankfully we had a unemployment at historic lows. The Wall Street and our markets were at, incredibly high. Like, thank God. Think about 2008 and then coronavirus on top of that, right? Like, we would all been living in a freaking park, right? Like, I mean, that's the thing, is like, this is why this is different. And thank God we had all of those things. But like, I know I have friends that had great successful businesses in the event and industry space, and they've been decimated. Like, they're bankrupt. They're going to be bankrupt. Like, I mean, they've lost everything. And look, like, it's one thing to have a business to be hurt by industry or unfair trade or anti-competitive natures or something like that happens over time. There are people that were basically Friday, pretty crazy. And then a week from that Friday, they had nothing done, right? And who knows when that comes back, or if it even comes back. So like, that's what everyone needs to be real about right now.
Yeah, absolutely. You mentioned margin calls, and I don't know if you want to take just a couple minutes just to give, I don't know if there's an elementary explanation of margin call, but I know a lot of people are probably hearing those things too.
Yeah, and again, I'm probably the worst person to answer that, especially trying to dumb it down. But I just say it's basically like money. You have to pay money, right? Like, so I'm trying to figure out a way. I'm just trying to figure out a way.
We can put probably a link to your other interview too.
Yeah. So I'll put a link to there, because Barry and stuff gets into it a little more. But basically, think about this, right? When a lender, right? And they have certain, it's almost like trading, right? In fact, it's not almost like it is trading on the back end. It's why they call it a secondary market. It's like a marketplace, like the Dow Jones or whatever, right? And again, I'm not explaining this 100% correct, but I'm just trying to find a way to visualize it, or at least articulate it in a way that may make sense. But every company has that secondary market to where they're selling their loans, right? And what the cost of that loan is, right? And what do they have on the portfolio, and what do they owe? And then they have what we call warehouse lines, where we put those loans and they basically fund them, and then the investor pays the money, and then that goes to the warehouse bank, and then we got another big line of credit, right? So hopefully that piece made sense, right? That's from the warehouse perspective. On the margin call is that you may have loans at a certain price, and then when that price isn't what it is, you have to pay for that difference, right? Or less, or if it's going to be a loss, you're paying for that loss, right? And Jeff, you know this stuff because you've been a good student of finances and the market and whatnot. But you're really paying for that. You're paying for that loss between what the value is and what's paid for that asset, right? And so the margin calls is when, like, look, like, this is what we have, this is what you owe, here's the difference in between. So a lot of companies that aren't well capitalized, I've known companies that have had to put millions of dollars in quietly to pay for those margin calls on the back end, right? So again, listen to the experts on that stuff. That isn't my world, but you're basically paying for the risk. It's happening. It's happened. It's already happened. It's happening.
So companies are getting calls saying we need X posted by.
Oh yeah, because like they don't have the liquidity to deal with that, right? Like, I mean, you just can't. You can't really. Well, you can, but you can't really plan, because you'll have reserves, right? Like, every company has what they call reserves, and that could be for loan loss. It could be for lawsuits or other things. They have reserves to basically pay for any issues, or if you have a loan that is being asked to be repurchased. Like, so for example, if I'm a lender, I do a loan, I sell it off to Chase, and a Chase would technically be an investor on the secondary market. If I do a loan and then I sell it off, and then I could get a repurchase if they found some material defect in the loan of underwriting, or we didn't calculate income correctly, or they didn't qualify. This happened a lot after 2008. You still have Lehman Brothers going through and trying to ding people for loans that they basically approved and they underwrit. But either way, you have Chase, and if they have a repurchase, and then let's say that loan was $300,000, like that's $300,000 you have to pay them. And so these companies will have reserves, and usually, depending on the size of the firm, or the mortgage company, could be a couple million, few million, stuff like that. But that is basically that's basically what we're looking at, is you got to cover those losses of what the value of that asset is.
Yeah. Well, and I can imagine too, if they have way too many locks out there, and with people either getting hours cut or losing jobs. I mean, I'm sure there's a lot of fallout there. And what was the other thing I was going to, and first payment defaults, I bet is going to be something.
Oh yeah. I mean, we've already seen that on the servicing side, where people haven't even made the payments yet. And they're talking about forbearance or not even pay that. And then, that hits, hits the loan officer with their commission, right? Because then that's the that's the big deal with them too. Huh? Yeah, it's a huge mess, man. I mean, it's just like there's so many different things that are happening right now to where it's just a waterfall effect, and you have this lead into that, and really it was kind of a perfect storm, because let's take it back a little bit. People were starting to get upset about the turn times and pricing, because we were having a capacity issue, because rates were just ridiculously low. Yeah. And so we were doing a ton of refis, obviously. Just to give you an example where we are. So the mortgage market in a given year, and let's just say, let's just take last year, for example. I want to say we did a little under $3 trillion in business as an industry last year, $3 trillion, right? When February was coming, I think it was February. I don't know, all these, like, this whole freaking months. I don't even know what day it is half the time now. But like when February was coming around, and we had we had some dirt cheap rates, and everyone wanted to refi. People were trying to refi basically. I think at one point there was probably $33 trillion of mortgage debt that could have been refinanced. You're not doing that in a month. You're not when an industry takes 12 months to do $3 trillion, you're not doing $33 trillion in a month or 2 months or 3 months or even in the entire, that it takes a lot to happen. And so that's basically that's basically where we were with capacity and then rates and then the economy and everything else. So it's been just kind of a perfect storm for the industry of just one negative thing after another with all that.
Absolutely, man. Well, we may have to have you back here in a few weeks if to give another update. Things are changing so fast. Yeah,
I mean it's crazy. And one thing that I mentioned that I wanted to touch on a little bit is the iBuyers right now. So if you're and I know you guys are in basically ground zero when it comes to the iBuyer market, but iBuyers have disappeared. Now which again is something that the industry has always talked about, like during times of strife or market volatility or a shift, that iBuyers, their model would not, that's been the one ding on them, right? And of course there's no evidence because of course we're just living in the golden age of real estate and tech and everything else, right? So obviously there's no proof. They remove themselves pretty quickly. Now I have always been I want to say a proponent, but I've been I haven't gone the way that most people did. I was at Inman when iBuyers were basically first announced, and the entire room said there's no way this model would ever work. Consumers would never net less and blah, 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 blah. It's been proven wrong, right? Obviously there is a market for that and buyers would do that, right? Now, me not agreeing with the masses about that does not make me a proponent of iBuyers. I think there's a market for it. I think it meets what people's certain circumstances are, and it may make sense, right? I don't think it's going to be a huge piece of the market, but it's going to be a piece of the market. And anytime you take away a piece of a pie, you know what that means? It means it's a smaller pie. So that's just one thing to keep in your head. My issue with iBuyers is, one is the way they screwed over consumers, which I thought was pretty bad, right? Not all of them and not every consumer, but there was some pretty bad stuff that had happened that I'm sure some people have seen in Facebook groups and some other, and Twitter and stuff like that, of consumers that got their contracts canceled. And I think Zillow was offering, it's either Zillow or Open Doors offering like $5,000 or some stuff to some of these people or whatever. My issue wasn't with that, because look, again, these are hard times, unprecedented times. But I think it proves that their model isn't sustainable in the down market, and isn't sustainable as a alternative, like a true alternative to traditional real estate, to an agent, which I think, and I am a proponent that a transaction include an agent, because I think that's where everyone's going to get the best value, and where the consumer is going to be the most happy with the right people, right? There's going to be agents and lenders where it's going to be a shitty experience, right? We just admit that, right? But here's where my issue is with the iBuyers. So I had posted basically this screenshot from a Facebook group, consumer Facebook group, not a real estate Facebook group, saying, I just, Open Door just canceled my contract and blah, 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 and all this other stuff. And I have a new house now, I don't know what to do. And so, but basically I was connected with the loan officer that helped that person get with a lender to actually close their loan. What bothered me about that, other than the fact that they were, that they did that, what bothered to me is their explanation. And all of them have, look, there's a valid reason to say, hey, market conditions caused by the coronavirus, COVID-19, however you want to refer to it as, is causing some issues, and we're not going to be able to do business, right? Like that's affecting everybody. Mm-hmm. But the way they said it, and I have the screenshot of it, of the one of the guys at Open Doors said, they basically are hiding behind it's a safety issue, right? They don't want to put people in danger. And not only that, but they're saying people that are continuing to do transactions are putting people at risk, which was the premise of their statement. Mm. And then you have other ones that are basically hiding behind saying it's a safety issue, not a liquidity issue, or not an investor issue, or not a capitalization issue, or a model issue. That's where I take issue with it, because it very clearly is an issue with their model. And the reason I say that is because guess what? There's loans closing today that involved an agent and involved a mortgage lender and didn't have anything to do with physical touching, social distancing, or quarantines. That happened today. That happened yesterday. That happened last Friday and Thursday. It's happened this entire time while their model's deciding to hibernate. And so my point is that if traditional shops or traditional methods or channels are able to continue to do business during this pandemic, then your model, above all, should still be able to do business during this time, right? And the only reason you cannot is if you have a capitalization, a liquidity, or a model issue, right? And that's the only thing. So what's going to happen, and I guarantee you, once the dust settles and the market returns to where it should be, the iBuyers are going to come back saying, yeah, we made these, whatever. There'll be some sort of an apology, non-apology, and then they will say, for safety reasons we did that, and now we're back, and basically they're going to not take any responsibility for what they did in their model. As an agent, and I posted about this and gave some basically my opinion. As an agent, right now you should be doing your research, get the articles from Forbes, from Housing Wire, from everyone else that has written about the disappearance of iBuyers. Go get the screenshots of the people on Twitter that got screwed over, the people in the Facebook groups, get the screenshots, and use that all as competitive marketing now for when you have to have those discussions. I also think the best alternative, and this I learned from Jason Cassidy, who's a loan officer in San Diego with Compass, is to do your own iBuyer program, right? Now is your chance. Look, iBuyers have basically paid to open up a market. Now you go find your own iBuyer, your own investor clients, so you could give them options, right? Now's the time. Look, they're on the ropes. Now's the time for you to step on their neck and use this to your advantage and have something to market against them with, saying, look, when the world went to shit, my model still did business. We still help families. We still solve problems. In fact, we solved the problems that the iBuyers couldn't do and that the iBuyers created. That should be your messaging going forward. And that you have all the proof saying, look, during this time, we were able to still help families. They were not. That's why you use a traditional agent. That's why you use a traditional mortgage lender. And so I'm only doing, and look, and I'd still be saying this as an opportunity. I wouldn't be so passionate about it if the iBuyers didn't piss me off with their PR crap about trying to say that it was about safety when it's not. It was about their model, right? And I'm happy to talk to any iBuyer, Open Door or whatever, that is going to say anything different and not mention the safety and tell me a reason why you're not doing business outside of the safety issue. If you can't do that, then shut up. If you can, then I'd love to hear it. And I'd have you on my podcast. I'd have you on anything till you explain why you're not able to do business that other people do and why you guys are the safety. But I'm saying this as a competitive piece for marketing is like, use this time, right?
Yeah.
Now is the time to market against that model and then come up with your own. So when they come back to market, there is nothing to come back to the market to because you've done it yourself, right? You've been shown the way. You've been shown that there are consumers that actually would prefer to just sell their house and get that less. Fine. You bring them that deal. You bring them that connection, right? Be the professional, be out front. They've done it for you. Now's the time to step on their neck. And so there is no market for them to come back to, right? And again, not that I ever am pro anyone losing jobs or any stuff like that, but they piss me off. And so I'm just, and again, I'm a proponent of the professional agent.
Right.
I'm a proponent of the professional loan officer, the local expert. I'm professional, both real estate and the mortgage side. And so that is the opportunity for you. And your opportunity right now, again, like I said in the beginning, be an advisor, be someone that someone could count on, be a leader in your community. Don't focus on real estate. Don't focus on mortgage. Focus on being a human being. And when we get through this, which we will, there's blue sky at the end of this, you will have no trouble getting any business. And there's nothing wrong with saying that because you're going to be getting business because you did the right thing during a crisis.
I love it.
That's great information.
Great point, man. Great idea. I think I saw Jason. You said Jason Cassidy, right?
Yeah.
Yeah, I think I saw when he posted when he rolled out his iBuyer.
Yeah. Learn from him.
And went to his website and everything. Yep. So, I mean, you can put in, that's a great idea.
Yeah, no, and I interviewed him about it, and he gave basically his entire playbook of what he does and how he created it. Like every agent could do that, right? And so that's what I'm saying is like, don't give them a market to come back to. Create your own now, right? Like get with the investors, and so when stuff does come back to normal, you have it. Don't give them 1 foot forward, right? Just make your own, and they will have nothing to come back to.
There we go. I tell you what, Jason, if you want to, I know you were going to send me the link for your interview with Barry Habib.
Yep.
Go ahead and send me, if you don't mind, the one with Jason too. And
yeah, absolutely.
We'll go ahead and share those and let agents know they should watch those for sure.
Yep.
Well, I appreciate you being on here, man.
Yeah, great information. Is as a real estate agent myself, I mean, the information you just shared was so valuable, and I hope the real estate agents who are listening to this podcast today take it to heart because it's amazing stuff. Good stuff.
Yeah, it's thank you guys for having me on here. It's I just, at the end of the day, like I love this business, right? It's a legacy for me. I was born into it, and there's a lot of great professionals and here that honestly get screwed over by the bad actors and the bad parts of this industry. And I want to see those that are the good guys and the good gals. I want to see them succeed and crush it, right? Those that want to, those that are trying to build something legacy for themselves. And I'm tired of seeing, good people get hurt by bad stuff. And so my focus since this has happened is to give as much value, as much education as I can out there, not make it about me or my brand or any of that other stuff. I don't really care about any of that stuff right now. I just care about helping people and getting through this because it's going to be a massive change for a lot of us. And I think, I think people just need to realize there's an opportunity there by doing the right thing.
Yeah, absolutely, man. I appreciate it, buddy.
Mm-hmm.
Well, thanks again for coming on. Let's see, you're
Absolutely.
You're out in Salt Lake still?
Yep.
Okay. I knew that you had moved from California over there, but
yeah, no, it snowed here the other day. We've also like it was funny is like a couple weeks ago we had an earthquake, 5.7, which was the biggest earthquake they've had since
Dustin
92.
Posted something about that.
Yeah, which is, I moved from the Bay Area in California, so like, and earthquakes aren't a big deal, but like it's a big deal here because they're not geared for it. But like, and that was basically like the week after the shit was really starting to hit the fan with the economy and quarantine and everything else. And then we get an earthquake and I'm like, geez, man, like Mother Nature is not happy with the human race right now. So it's just
God's wrath on.
Yeah.
On
God is like, seriously, I was waiting for like, I don't know any of the faith based people on listening to the podcast. I happen to be one, but I was waiting for that trumpet, man. I'm waiting to go outside and listen to those trumpets sound in the background. It's like, that's the only thing next, waiting for locusts to come, frogs falling from the sky. Like it was, we're like, I was waiting because we were on deck for all of that.
Wow. Well, thanks again for joining us today. It really is great information. You always do a great job. And again, if agents want to find you out there on social, they can go to Mortgage X, right? And see some.
Yeah. So Mortgage X on Twitter, Instagram, LinkedIn, just Jason Frazier, Mortgage X, or Jason Frazier. I mean, if you do Jason Frazier, Mortgage X, Google, whatever, you'll find a website or something. But the best way to connect, be a part of the community, listen to the smarter people than me talk about the industry and real estate and stuff like that. Mortgage X Mastermind on Facebook.
Awesome, man. I appreciate it. All right, agents and loan officers. Hopefully loan officers listen to this one as well. We'll make sure that gets out there. But thank you so much for listening in. And until next time, we will see you later.
Adios.
Adios.